If you're a freelancer and you've been working with a financial advisor, or you've been following standard financial advice online, there's a good chance the strategy you're using right now was not actually built for you. And I don't mean that in a vague, general way. I mean the specific accounts, the specific recommendations, the specific products you've probably been pointed toward were designed around a completely different type of person. And this video is going to show you exactly why that keeps happening. Here's what we're actually covering. This is the third video in a series on Freelancer Financial Strategy, and by this point we've gone through the SEP IRA trap, the pro rata rule, the solo 401k, the QBI deduction, and the S-Corp election. If you haven't seen those yet, go watch them first because this one builds on all of it. What we're doing now is zooming out and looking at the industry itself, the structure, the incentives, the business model, because once you see how it works, the pattern of bad recommendations stops feeling random and starts making complete sense. So let's start with something that sounds almost ironic when you first hear it because it's one of the most revealing things about how this whole system operates. A huge chunk of financial advisors are themselves 1099 workers. Independent advisors who operate under an RIA firm or a broker-dealer don't get a W-2, they get a 1099 just like you. They deal with quarterly estimated taxes, income volatility, the self-employment tax hit, the same retirement account decisions you're wrestling with. They are, in the most literal sense, in the same financial situation as their freelancer clients. And yet the advanced strategies that would directly benefit those clients, solo 401ks, QBI deductions, S-Corp elections, often don't show up in the recommendations those advisors are making. The cobbler's kids have no shoes, as the saying goes, and the reason for that isn't laziness or bad intentions, it's the structure of the industry itself. FINRA regulations, broker-dealer compliance requirements, revenue incentives, all of it shapes what advisors actually do versus what they theoretically could do. The system has its own gravity and it pulls in a specific direction, so even advisors who know better often end up giving advice that fits the system rather than advice that fits you. But that's just the first layer. Because there's another category of advisor that creates a completely different set of problems, and this one is more direct. Commission-based advisors earn money by selling financial products, annuities, life insurance policies, certain mutual funds. Some of those products pay 5 to 7% upfront commission to the advisor who sells them. An annuity, for example, can be a legitimate tool in the right situation. There are real use cases for it. But it also happens to be one of the highest commission products in the entire industry. And here's the contrast that matters. Setting up a solo 401k pays no commission. Explaining the QBI deduction pays no commission. Walking you through an S-Corp election pays no commission. So if you're sitting across from a commission-based advisor, the products you're most likely to hear about are the ones that generate revenue for that advisor, not necessarily the ones that are the best fit for your actual situation. That's not a cynical take on the industry, it's just how commission structures work. The incentive shapes the recommendation, almost automatically, even when the advisor isn't consciously aware of it. That's important on its own, but if you don't also understand the AUM side of this, you're only seeing half the picture. AUM stands for Assets Under Management, and it's the other dominant revenue model in financial advising. The way it works is simple. The advisor charges you a percentage of the assets they manage for you, usually somewhere around 1% per year. So if you have $500,000 in accounts they manage, they're making $5,000 a year from you. If you have $1 million, they're making $10,000. The more assets under their management, the more they earn. That's the model. Now think about what that means for a freelancer who's considering a solo 401k. A solo 401k is typically self-directed. You control it, you manage it. Which means those assets are not under the advisor's management. They're not in the pool that generates the advisor's fee. So there's a quiet built-in disincentive for an AUM-based advisor to push you toward a solo 401k, even if it's the objectively better account for your situation. They don't have to be malicious about it. They don't have to consciously think, I'm going to steer this client away from the better option. The incentive structure does that work automatically. The SEP IRA, which is easier to set up and often easier to integrate into a managed portfolio, just keeps showing up as the recommendation. And this is where you start to see the pattern, because it's not random, it's predictable. The same recommendations keep appearing. Open a SEP IRA, contribute what you can, maybe look at an annuity, and they keep appearing because they fit the business model of the advisor, not because they're the best fit for a freelancer's specific situation. So let's actually talk about what that specific situation looks like, because this is where the real cost shows up. Freelancers don't have W-2 income. They have irregular cash flow, self-employment tax, quarterly estimated payments, business deductions, and retirement planning needs that don't map neatly onto the standard playbook. A W-2 employee gets their taxes withheld automatically, contributes to a 401k through payroll, and has a pretty predictable financial structure. A freelancer is managing all of that manually with income that can swing dramatically from month to month, and the tools available to them are genuinely different from what a salaried employee has access to. The SEP IRA is a perfect example of this mismatch. It's marketed as the easy retirement account for self-employed people, and in some situations it genuinely is fine. But it has a major structural problem that almost never gets mentioned. It creates what's called a pro rata issue if you ever want to do a Roth conversion. Basically, if you have pre-tax money sitting in a SEP IRA and you try to convert any IRA funds to Roth, the IRS treats all your IRA money as a blended pool and taxes you on a proportional chunk of the conversion. It wipes out the strategy, and the solo 401k doesn't have this problem because it's not an IRA. It's a separate account type that sits outside that pro rata calculation entirely. So if Roth conversions are part of your long-term tax strategy, and for a lot of freelancers they should be, the SEP IRA can quietly close a door you didn't even know you wanted open. The solo 401k also lets you contribute more in most income scenarios. You're contributing as both the employee and the employer, so the math works in your favor, and there's a loan feature that almost nobody talks about, which matters a lot when you have a regular income and you need access to cash without triggering a taxable event. That's a real functional advantage for a freelancer, and it's one that basically never comes up in standard financial advice. Now, the QBI deduction is another one that gets ignored constantly. If you're a freelancer operating as a sole proprietor or an S-corp, you may be eligible to deduct up to 20% of your qualified business income. That's not a small number. On $100,000 of net self-employment income, that's potentially a $20,000 deduction, which at a 22% tax rate saves you $4,400. No complex setup required, it's already available to you. But because it doesn't fit neatly into an investment product or a managed account, it often doesn't come up in the advisor conversation. And then there's the S-corp election, which is probably the most underused strategy for freelancers who are earning above a certain income threshold. Here's the basic idea. As a sole proprietor, you pay self-employment tax, which is 15.3%, on all of your net earnings. As an S-corp, you split your income into a reasonable salary and distributions. You only pay self-employment tax on the salary portion. The distributions don't get hit with that 15.3%. So if you're earning $150,000 or more as a freelancer, the S-corp election can save you several $1,000s a year in self-employment tax alone. It's not for everyone. There's administrative overhead, payroll setup, and it makes most sense above a certain income level. But for the right person, it's a significant lever, and it pays no commission to anyone, which is probably part of why it doesn't come up more often. If you're watching this and realizing your current setup might have some gaps in it, drop a comment below and tell me which of these landed closest to home. I actually read through the comments, and it helps me figure out which topics to go deeper on next. And if you're not subscribed yet, do that now, because the next few videos are going specifically into solo 401k mechanics and S-corp elections in detail, the actual setup process, the mistakes to avoid, the numbers, and you don't want to miss those. So let's pull the whole picture together because there's a clear through line running through everything we've covered. The financial advisory industry runs on two main business models, AUM fees and commissions. Both of those models have built-in incentives that create friction specifically for freelancers. AUM advisors make more money when assets are in accounts they control, so they have a quiet disincentive to help you maximize a solo 401k you manage yourself. Commission-based advisors make money selling products, and the best tools for freelancers, solo 401ks, QBI deductions, S-corp elections, don't pay commissions. And on top of that, freelancers are categorized internally as high complexity, low predictability clients, which means the industry's business model wasn't really built around you in the first place. The result is a predictable set of recommendations that shows up over and over. Open a SEP IRA, it's easy. Contribute what you can. Maybe consider an annuity. And that advice isn't necessarily wrong in every situation, but it consistently leaves out the strategies that would actually move the needle for someone with your specific financial structure. What you actually have available to you is this: a solo 401k that sidesteps the pro rata trap, includes a loan feature for cash flow gaps, and lets you contribute more than a SEP IRA in most income scenarios. A QBI deduction that could save you thousands per year with no complex setup. An S-corp election that can cut your self-employment tax bill significantly once your income hits the right level. And now a clear understanding of why the easy recommendations keep showing up, so you can ask better questions when you're sitting across from an advisor and actually know what you're evaluating. You came into this video knowing something felt off about the standard advice. Now you know specifically what that is and why it keeps repeating. That's not a small thing. Most freelancers don't figure this out until they've already paid the cost of the wrong setup for years. The goal here isn't to tell you to avoid financial advisors completely. A good advisor, a good CPA, and a well-structured retirement strategy can absolutely help a freelancer build real wealth. But you have to know what questions to ask. You have to understand the incentives in the room. You have to be able to tell the difference between a recommendation that's genuinely built for your situation and one that's simple, profitable, or convenient for someone else. So before you open a SEP IRA by default, consider a commission-heavy product, leave your QBI deduction on the table, skip the S-corp conversation, or decide a solo 401k is too complicated. Pause and get the full picture first. Because freelancers don't have the same financial life as W-2 employees, and you shouldn't be running on the same generic playbook. Go watch the solo 401k strategy video next. It's linked right here, because that's where we get into the actual mechanics: how to set one up correctly, how to avoid the administrative mistakes that can get the account disqualified, and how to use the loan feature without creating a tax problem. It's worth your time. This video is for educational purposes only and is not personal financial, tax, or investment advice. Talk to a qualified CPA or financial professional before making any decisions based on your own situation.